Hey guys, Kill Stokes here. Welcome back to the Trading Edge video, your weekend market outlook. I got two trading opportunities I want to take a look at today, one on a Forex pair, one on a commodity, so short and sweet this week. But before we get into it, I want to remind you that on March 25th, we're hosting a week-long free online trading workshop. We have our final meeting this Monday about the details, so hopefully we'll have some websites and stuff out shortly where you can sign up, register your spot, and get all the information you need for it. But until then, mark your calendars, March 25th, free, online, 1 week trading workshop. And if you ever been to any of our past workshops, you know it is an experience like no other. So make sure you plan to check it out. Today we're going to talk about a little bit of what we're going to talk about in the workshop, which is the IPDE process, a four-step process that I believe every trader should follow, or at least kind of customize and make it your own. That way you can stay consistent, because as you know, consistent analysis plus consistent execution equals consistent results. And especially if you're someone that is using multiple time frame analysis, meaning you're looking at different charts to gain perspectives on the market before you go in for the kill, it's going to be very important that you stick to such a process. That way you don't get confused about what you're looking for. So we're going to start here on the Aussie Yen on the daily. And this is a pair that gives us an interesting situation and really a difference in perspective depending on what time frame you're using as your higher time frame. You're going to see that if you use the daily, you're going to get stuck at one part of that four-step process. If you're starting on the 4 hour, maybe going down to the hourly, you're going to get to kind of fulfill and see out that process and actually have a pretty good trading opportunity. Now, the main thing that you want to consider as a trader is you don't want to put yourself in a situation where you can do both, right? You want to have hard set rules on what time frame you're using for what and how that allows you to progress in that process. Because something that many traders will do, and I have a podcast coming out about this soon, is they will see what they want to see, or they will see the thing that allows them to do the thing that they want to do. And that's a very bad habit, especially in something like trading where we are independent and there's no one telling us that we can. It's very easy to make up stuff in our mind and justify it by whatever reason we choose to justify things and then actually do it. So I'll give you two examples. One here on the daily of that IPDE process, which will be quick and short. The other one will be on the lower time frame, which will offer a different opportunity. So the IPDE process is identify, predict, decide, execute. So the first thing I want to do is I want to identify what has price action done, where is price action at. That's going to allow me to make a prediction. I have this orange line drawn out here, which is represents our previous structure high. And we're going to see that when I identify what price action did, we have to raise it a little bit with this test, we're going to see that price action tested this high, kind of created a new one. So we raised that bar up, but we never broke and closed above the high watermark, because as we continue to make new highs, they become the new high watermark. So right then and there, that's what I identify. When I go on to my prediction phase, which direction do I think price action is likely to go in next? I don't really have an answer. My answer initially would be short because we haven't broken structure, but I definitely can't predict that we're likely to go long. So right then and there, the trading opportunity is over. So if you're on the daily chart, it's simple. If you're on the 4 hour chart, however, you have a different perspective, because that same level on the 4 hour chart, because we have more candles on the 4 hour than the daily, you can see that that same level was actually violated right here. We had a break and a close above. Now on this chart, knowing that I have a break and close above structure, knowing that I identify that, it allows me to make the prediction that price is likely to go higher. Then I ask myself two questions. One, if price is likely to go higher, then where are we likely to go higher to? And we have some levels drawn out already. We don't need to discuss those in this video, but they're based on structure from a long time ago. That's where is price action likely to go? That's going to set up our targets and whatnot. And also, how is price action likely to get there? And one of the ways that price action is likely to get there is in the form of a pullback or relief. So when a trend becomes exhausted, it gets tired, right? It takes a little bit of breather and it gives us some relief. And typically that relief comes down into a previous level of structure. Look left, structure leaves clues. It's horribly drawn box on, but we have a nice little, again, structure consolidation level right here that's been tested multiple times in the past. So no surprise that price has come here. So a trader looking for that pullback trade, right? You're looking for that pullback into that zone. You can bring Fibonacci's in as well. Again, trying to make this a shorter analysis and not as confusing. So just focusing on kind of structure, but you can see we come to that 50% Fibonacci level as well, our RSI, our relative strength index, also goes oversold, telling us that, hey, this may be a place that we're looking at for potential longs. Now, if you're looking for potential longs, a great way to get involved is a higher high, higher close. We actually had that right here. Now, it's a very big candle, which is going to really mess up your, not to say mess up, but affect your risk reward. But depending on where you're shooting for targets at, it may not be that big of a difference. And I'll show you how. So if I'm looking at this right here, right, this is my entry. Let's say I'm taking a higher high, higher close as my entry. And again, this is the whole identify, predict. We decided what direction we want to be on, what we need to get involved, and then E is execute the trade. That's where we actually pull the trigger. So let's say this is my entry right here. Boom, again, it's a larger than normal candle. Not ideal. We'd want something smaller to give us less risk, but because there's so much opportunity in this trade to the upside, we can still make this work. If I'm doing a simple ATR based stop, let's see that entry candle ATR was, do some quick math or maybe embarrass myself, 22. Let's say 22 minus the low, that should be 13. Correct me, internet people, if I am wrong. That's going to put a stop loss, actually not as bad as I thought, right around here, right? So a stop loss right underneath this level. If you're looking for the extension higher, then obviously this risk reward is going to be massively in your favor. This is a great place. But even if you're looking for, let's say, a retest of the high watermark, you're still getting a pretty decent risk reward. And of course, you can split it up like we spoke about the other day with multiple targets. Take a portion off at target one, take a portion off at the extension, maybe hold one on for the further extension as well, depending on kind of your trading style. Now, this is one way to go about it. Now, another way to go about it would be this. Let's say that you're someone on that daily chart. You don't have that higher high, higher close, so you can't make that prediction. But maybe you go down to your lower time frames and you see new clues that are added to the equation. Well, if we drop down one more time frame to the hourly, we have another interesting circumstance that happens because we have a little bit of a short-term trend rotation. We can see that price action comes down. We do all this dance, right? Blah, 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 blah. We form a little bit of consolidation over here. We drop down. We consolidate, accumulate a little bit more over here. Again, look left. Structure leaves clues. We actually repeat it, right? The same type of deal right there as well as down there. We raise up to retest that previous level of consolidation. Let me zoom in on my chart here so you guys can see it a little bit. Give me some real estate. Boom, boom, boom. And then we consolidate once again, giving us, right, yell it out, yell it out, yell it out. What type of pattern is this? Scream it, someone, come on, please. Left shoulder, hit, right shoulder, a head and shoulders pattern, head and shoulders bottom, which is a classic reversal pattern in the market, a complex reversal pattern in the market, right? So what we want to do for head and shoulders is we want to measure our neckline, which is the highest point of structure right here. You can see that once we violate this neckline, this kind of resets the process, right? Because we have a head and shoulders, the complex end of this downward move, right? We violate that neckline to the upside, identify, higher high, higher close, and now we're pulling back into previous structure. So this area right here is a perfect place to look for a pullback trade, and we can look at this in one of two ways. Again, if you are someone that has that higher time frame bias that we're likely to go bullish, this could be your entry into that bigger trade. I'm drawing stuff all over the place. I'm gonna try and zoom out for you. Let's make this skinny. Let's say this is our secondary one right here. Let's say we enter somewhere in there, right? You can look at it the same way as that being your entry reason into the bigger trade, except for now at this level, you don't need stop losses to be all the way down here. You can have them right below that shoulder because that's where you would be wrong at. And you can still shoot for a retest of the high or the extension or whatever you want to shoot for, right? Based on those higher targets. Or if you're someone that doesn't have that higher time frame bias, you're on the daily and you're like, hey, Akil, because we didn't violate, I can't predict an extension, and that's the category that I fall into since I use the daily chart. You can still look at this as a head and shoulders trade in its own right. All you have to do is kind of just make a new prediction instead of expecting or predicting, pardon me, market, we should never expect anything. Instead of predicting that we're likely to continue higher, we want to identify the next likely place we're going to, and we have this nice little consolidation point, if you guys can see it, right in here. So we can still set ourselves up with a trade where it's like, hey, I enter somewhere in here, stops are right below that shoulder, and then targets are right up at that secondary zone, or that smaller zone right up here, and I'm still getting a wonderful 2-to-1 risk reward. So, different ways to approach it, and I showed this example for two reasons. One, you can be very creative in trading in a rules following way, meaning if you have the skill of technical analysis, if you understand the markets, you can look for different ways to get involved in the same type of move. I think many traders think there's only one way to get involved in every move, and that's not the case, right? The market will sometimes give you one chance, but sometimes the market will give you multiple opportunities. And if you're skilled enough, and maybe you don't get the first one because it doesn't meet your rules, instead of forcing trades, you can sit back, wait for the next one, be creative, and wait for the market to give you other opportunities. Two, to show you the difference between how two traders can look at the same chart from a different perspective and really have two different predictions. One is continuation, one is not continuation because of how they analyze that initial higher time frame, yet still be looking at similar moves in the same direction, just in a slightly different way. And the cool thing that you'll notice about trading is it's Jason and I spoke about this on the coffee break this past Wednesday about mastering trading, is that again, there really is no mastery because there's so much out there you can do. And our job as traders, and this is something I've realized with myself over the last 15 years, is that what happens is if you dedicate yourself to the market, if you keep working, you just slowly get better at these little things, which in their own right seem pointless, but when you combine them with all the other knowledge it just continues to inch you closer and closer on that scale to mastery, and that's pretty cool. Next up, we are taking a look at that yellow metal gold, and gold is in a really interesting situation, both technically and fundamentally, or I'm going to say fundamentally. We'll start with the technical side, I guess, right? Gold is at this area right here, right? Back in December, I believe this was, because I sold a little bit of my gold here, right? We had this massive spike up almost to 21.5, and then we got rejected and came back down into this consolidation. And you see price is currently trading right back at the very highs of this consolidation. So from a technical perspective, we are at a very nice rejection point. We're at a very nice psychological level as well for two reasons, right? We talked about this with the Euro Swiss the other day. When you're at all-time highs and all-time lows or key levels of rejection, you get two ways of thinking. You get one way of thinking is like, oh my gosh, we've been at this level before. We can have all-time highs. I get excited. I want to buy. The other way of thinking is that, hey, people are going to start cashing out at this level because this is as expensive as it's ever gotten. There's no proof that it has gotten more expensive than this. Maybe I want to kind of start liquidating some of my position at this level, and that's going to affect the market. Now, if we look at this from a deeper fundamental perspective, and sorry for the noise in the background. I got two kids playing around. It's the weekend here. But if you look at this from a fundamental perspective, I don't really see a reason for gold to be this high. Now, there's a lot going on with interest rates. Again, we were set to have a historic year of interest rate cuts, and so far we've got nothing. And the tide is kind of turning to maybe we won't have any this year as we keep track on these inflationary numbers. We actually have a jam-packed news event week this week. I think there's a meeting, a Fed chair, Jerome Powell speaks this week. There's a lot going on. There's ISM, there's a Fed chair speaking, there's unemployment, there are some other jobs numbers coming out, there's a non-farm. It's a very busy week of news, so we'll have to keep track here. But essentially, I don't see any reason for gold to suddenly have this rally. And part of me thinks it's nothing more than just a little end of week, end of month type of movement where people are kind of balancing their sheets and whatnot. So with that being said, I would look for a counter trend trading perspective here on gold. We're at a previous structure high. We do have this spike to worry about, which is interesting because stops aren't necessarily going to be as safe as you'd want them, knowing that this is a range that could be tested. But we're holding at a previous level of structure high. Let me get this straight for you guys. You can see we ended the week with a big rally candle and a little bit of rejection at the top here. If we can get a 3-bar reversal, and specifically if we can get like another pin bar where maybe price makes another run at these highs like that, but we end up getting a lower low, lower close like that, I think that's a very good sign for a potential short term, right? I got to say that loud, short term counter trend move here on gold. where we work our way back down into this level right here. Now, if you're someone that wants more confirmation, right, this would be an aggressive way. A less aggressive way would be by waiting for a double top, and an even less aggressive way would be waiting for a 2618. So again, this is something that we teach in our courses where, hey, there are multiple ways to get involved in a trade, and as a trader, you have to kind of decide what your personality is. Are you super aggressive, limit order right there, let's do it, baby, whoa, right? Or are you super conservative where you're like, hey, I need every sign in the world that this thing is going to reverse before I feel comfortable getting involved? And of course, there's everything in the middle, and there are pros and cons to either one. You know, for example, if you're using an aggressive limit order, you will catch every move. That's a good thing. The bad thing is that you will catch every move. So the ones that blow right through your orders and get stopped out, you're going to be in them as well, right? For a conservative trader, you may miss moves because you're waiting for so many things to line up, but you also avoid some of those moves that get skunked out right away. So, you know, before you start asking, well, what's the best way, Akil? There is no best way. It's all about knowing what suits your personality best and finding that balance. But just like we spoke about earlier with the other opportunity, if you are skilled at analyzing the markets, you can have different ways to look for this. You can look for your first strike. You can look for your second strike. You can look for your third strike. So even if the market doesn't give you what you want right away, you can also still find opportunities to get involved. And I think that's a very powerful tool for us traders, because the honest truth is that good trading opportunities don't really come along too often, right? A lot of our Tier 1 members are experiencing that right now as they're getting into their testing phase. They're like, man, this doesn't happen a lot. I'm like, yeah. So it's super important that when it does happen, when those grade A trades do show themselves, show yourself, show yourself, fool, right? When those grade A trades do show themselves, it's very important that we have ways to take advantage of them. It doesn't mean we're going to get involved in the trade, but at least we want to have or put ourselves in a position where we have the greatest opportunity to try to get involved in those trades. Before you leave, hit that like button, subscribe if you are new. That way you can stay in the loop. You don't miss the details about our upcoming trading workshop on March 25th. Also, if you want more Akil, right, if you're not tired of me yet, make sure you check out the Trading Coach Podcast. 3 brand new episodes a week covering various topics. They're short, they're quick, they're enjoyable, they're funny, they're very informative. I think you should make it kind of a routine part of your trading journey if you're looking to kind of advance as quickly as possible in the best and the most efficient way as possible too. So check it out. It's available on your favorite podcasting app 3 times a week. All right, until next time, plan your trade your plan. Take care and enjoy your weekend.